Let's talk about the rate and points relationship. So first, I want to start with some basics. With most mortgage products, there's typically a number of different interest rates available on any given day. There's a base rate, and then there's also options with points. Now, points are really just an extra fee that you pay at closing to get a better rate for the life of the loan. 1 point equals 1% of the loan amount. So if you're borrowing $300,000, 1 point, $3,000. Now here's where the nuance comes in. If you're really focused on your monthly payment, oftentimes if you borrow just a little bit more, but you pay a point to get a better rate than you would have with no points, that'll yield a lower payment than the alternative. So here's a quick example I'll run through with you. Let's take today's conventional 30-year fixed rate from Mortgage News Daily at 6% and assume that loan amount at $300,000. The monthly mortgage payment for principal and interest based on $300,000 at 6% on a 30-year is $1,798.65 a month. Now let's look at an option with 1 point, but push the loan amount up to $303,000. And that pushes the rate down to 5.75 because you're paying a point, although the cash to close is pretty similar because we pushed the loan amount up a little bit. The monthly mortgage payment at 5.75 for 30 years is $1,768.23 a month. All right, let's go one step further and let's pay 2 points but borrow $306 now. So that pushes the rate down to 5.5. At $306, payment is $1,737.43 a month. All three of these options, as I said, are going to have very similar cash to close, but obviously the payment fluctuates depending on which option you go with. Doesn't mean that everyone should pay points though, because there's other factors that come into play, but you should at least can look at the options and consider them.